Hey, hi, Himanshu. Hey, hi, Adrija.
Good morning, sir. Hello.
Hey, you're audible.
Yes.
Adrija and Himanshu, you both are FMEA students or you're doing pre-CMA? Okay, so Himanshu, you are into pre-CMA. Okay. And Adrija? Adrija, if you're speaking something, you're not
Can
audible.
you repeat the question? I couldn't hear actually.
Okay, so yeah, so are you a pre-CMA student or an FMA student?
I'm a pre-CMA student.
Okay. So have you enrolled for the class or you would be enrolling like both of you?
Oh no, sorry. I'm a FMA. In Uplift, I'm an FMA. I'm actually doing CMA from a different institute.
Okay. Okay. So no worries there. Just give me a moment. Okay? Yeah. So before starting, like just to check that, just am I audible to you guys clearly? Because I can see a lot of disturbance at my end.
Audible.
Okay, thanks. Okay, so for this one, for this class or this session, we'll start with a concept called cost management, which is basically a kind of a very important concept when it comes to CMA as a whole and FMAA as a whole, because whole of the things in this course are basically dependent on how do you understand this concept. Because you would be a CMA or a FMAA expert, so because of that, that makes this concept a bit more important, because it's kind of a core concept. So this is like the overall base of all the studies which you are going to make. So before that, let me just give you a quick flow on how the things basically work. Is that the management okay, so what happens exactly is the management during the start of the year, they decide that what kind of a revenue they are expecting, and based on the revenue they prepare a detailed budget. Okay, just give me a moment, guys. There are a few students joining in as well. I just got a message on the group, so just wait for a couple of minutes. Okay. Okay, so let's continue because I'm not sure if it's still only join. So, okay, whatever. So what happens is the management has a revenue target, and that revenue target is basically achieved by preparing a budget. So that's kind of a primary thing. Once a budget is done and you have the figures, then as we discussed earlier as well, we do a variance analysis. So once the variance analysis is in place, what we can do is we need to revise the things and again go back to the budget, change it to a certain extent wherever it is required. So this process is called as forecasting. And once this, then again the cycle basically will continue. So it would be a new kind of a budget for the remaining period. Then there would be a variance, then there would be a revision, then there would be a forecasting again a budget variance, and this kind of revision will continue. So budget will come back to budget, because for doing a variance analysis we require a kind of a base for having budgeting concepts, but we would be covering the budgeting questions and budgeting concepts once we are through with this whole process. So for understanding the process, it was essential that you understand what exactly budget means and what kind of things it has, and then we can move to the variance part. So when you prepare a budget, you need to estimate what are your costs, right? So cost, when it comes to cost, it is more precisely the per unit cost which we are talking about. So there are two interpretations of it. One is the per unit cost, and then it gets multiplied with your units. What are your estimated budgeted answer to this? So now it is very important that this per unit cost is something which you need to define as a cost management accountant or as an FMAA expert. So there are different methodologies wherein this per unit cost can be taken up, can be found out. There are a few calculations which you need to make, and that is something which forms the core base of CMA. Because you're a cost management consultant, it becomes important that you understand what type of the costs are going into the system. And that's why it is important that you should be thorough with the concepts of classification of costs. So this cost management and performance matrix, the section D of the course, basically covers 20% of your examination. It's kind of a very lengthy kind of a concept. It has got too many concepts into it, and it's better that you keep on preparing a note side by side, so that will help you to revise the things along. So the first one is the classification of the costs, which is into variable, fixed, and mixed cost. So when it comes to classification of the costs, a cost which basically increases, when there is an increase in the production units. So cost is increasing as the production units are increasing. So this is your cost, and it is increasing based on the units. So these is based on the number of units you produce. If you produce less number of units, you should be having less cost. So it varies on number of units you make. On the other hand, there is a cost which is called as fixed cost. So fixed cost is a cost which remains constant irrespective of the units produced or units manufactured. So there is a key classification between these two costs. So variable cost is something which is going to go up and down based on your units. Fixed cost would be something which would be constant. So, for example, if the number of units produced are 10, 20, and 30, the associated cost, the variable cost associated with these units would also keep on increasing based on the number of units which you produce. But on the other hand, if you consider the fixed cost, it would always be constant because it's fixed. Okay. Then there is something called as semi-variable cost. So what do you mean by semi-variable cost? So semi-variable cost is a cost which remains variable to a certain point and becomes constant, or it could be constant for a period and then it would jump immediately. So it would be, for example, it would be constant, then it would jump to a certain extent, then it would be constant for a certain period, then it would jump again. So if you see, the nature of this cost is kind of a stairs. This is called as a step cost as well. On the other hand, the fixed cost would always be fixed. The variable cost would either increase or it would decrease. So if you want me to draw it on a graph, how does it look? Let me just brief you on that. So if this is your graph and you're trying to analyze what kind of a cost is it. So if it is a variable cost and we're assuming that the production is going high, it's a kind of an increasing production, for an example. So let's put it here as the production is increasing. In that case, what is going to happen is, if you have 0 units, what happens if there's 1 unit, 2 units, and 3 units? So say the cost is $10, $20, and $30. So for every 1 unit you produce, you have a cost right here. That's kind of an intersection point. So for 1 unit, it would, so these are units. And these are the costs on the left hand side. So for 2 units, it would be, say, for example, 20. And for third unit, it would be, say, for example, 30. So the variable cost curve, because we have like kind of an increasing production right now. But on the other hand, if you want to draw a curve for a fixed cost, it would be fixed for a certain number of units. So let's say, so until 5 units, the fixed cost would be constant. So it doesn't matter how many units you produce, you're going to pay the same amount every time. So until 5 units, let's say the fixed cost is 30. So this becomes your fixed cost. This becomes your variable cost. And then there is something called a semi-variable cost, which means that to a certain extent, it is going to be fixed. And after that, it is going to get increased. So it would have kind of a step pattern. So it would be fixed until it produces 2 units. For third unit, it will again jump up to 30. It would remain constant until 4 units. And again, it would like kind of a jump over. Again, it would be constant for a period. Again, it would jump over. So there is a fixed pattern into it. And once you draw the graph, you'll end up having a stairs pattern. So this is kind of a very, very basic definition of these costs. But then let's try to find out some of the examples. So for variable cost, the most primary example is the raw material which you use in your factory, in your machinery. So the raw material required would also increase if you're going to increase your production. Let's say for fixed cost, let's assume that the rent which you're paying for the factory is irrespective of the fact that how much number of units you produce. So if you are the lender of the space, you are basically not concerned of how much production the company is making. You're more concerned, are you getting your rental cost or rental income at a designated date? So irrespective of what the production the company is making, you're going to get your income. You're going to get your money back. So that is something which is fixed in your hand, and that is kind of a liability, a fixed liability for the company to pay off. That is something which is called as fixed cost. It is irrelevant of the number of units. It is irrelevant of the number of productions. It is irrelevant of the number of employees. It doesn't matter. For example, there is another cost which is called as, so there is rent is one, and there are some other costs as well. So for example, the rental cost of machinery can be fixed, but then if there is a rental cost of space, that is the area, it could either be fixed or variable. Sorry, it could be fixed or semi-variable based on the conditions which you have. So what I mean by that is, let's assume that this is your factory and you have kind of 4 machineries installed into this factory now. So let's assume that this is one of your machinery right here. So these are like kind of 4 machineries you basically have. And because you have installed the machinery, you require a space. And for this, you're paying a rent. And that rental cost is basically the cost irrespective of the fact that if any of the machinery breaks down, it doesn't matter. You still have to pay the cost. But what if you want to install a 5th machinery? You'll have to again buy some kind of a space, kind of an extra space. And that space would again cost you something. Again, you'll have to buy some space and you have to kind of pay the rent for it. So again, in that space, you still have a scope of having 4 machineries. But currently, you're only in a capacity to produce or in a capacity to install a single machinery. So what is going to happen is, although you have space for 4, you end up paying the rent for the whole space. So the landlord or the person from whom you're taking the space is basically not considering the fact that you only have 1 machinery to install. He'll say that, look, brother, this is the space and this is the rent. Even if you install 5 machineries, I don't care. Even if you install 1 machinery, that is none of my business. So the point what I'm trying to make is, until we have got 4 machines, we have got a limited space. So the cost until that part is fixed. But then for the next machine, that is, if you want to have a 5th machine, there's a sudden rise in the cost because there's a space constraint. So what is going to happen is, so until 0 to 4, your cost would be constant. From 5th to 8th, it would again be constant, but there would be a rise from 4 to 5th. And these costs are basically called as the semi-variable costs. So a cost which to a certain period remains constant and then increases. Does anybody have any questions on this? Okay. So, so variable costs are such costs which are like materials, labor that are incurred, material cost or labor cost that are incurred when the product is made. So the product is not made, you're not going to incur that cost. But then there is something which you need to understand as well, which is the per of the variable cost. So variable cost, when it calculated on a per unit basis, would always remain constant or unchanged. So usually what happens is the fixed cost in totality remains the same and it changes per unit. Whereas the variable cost per unit remains the same and changes in totality. So this kind of a mixed concept, but let me just give you a quick example on this, so this will make a bit more sense for you. So what we discussed was variable cost. So I'll just draw a quick table for you. There is a variable cost, there is a fixed cost. So what happens on a per unit basis? So if it is a per unit basis, the variable cost would remain constant. I'll tell you why through an example. But the fixed cost would change. And then what happens in totality is the fixed cost, or the variable cost changes in totality, whereas fixed cost remains constant. So let's take an example. So if the number of units which you need to produce are 10, so let's not take it 10, let's take it 1, 2, 3, 4, 3, 4. And then when you want to calculate the variable cost, there would be a per unit cost which you already have with you. So let's suppose the variable cost is $2 for 1 unit. So $2, it's per unit. So variable cost $2 per unit would be multiplied by 2, multiplied by 2, multiplied by 2, and multiplied by 2. So for 1 unit, the cost is 2. For 2 units, the cost is 4, 6, and $8. On the other hand, the fixed cost would always remain constant. And let's assume that the cost is, say, $50. That's kind of fixed cost we're talking about. Well, let's say it's 5. Yeah. So when you take a total of this, so it would be 7, 9, 11, and 13. So what the concept says is that if you calculate the fixed cost now, so if you calculate the fixed cost per unit, if you calculate the fixed cost and on a per unit basis, it would keep on changing. Why is it so? It's because it's kind of a simple division. Fixed cost per unit would be 5 divided by 1, that is equal to 5. Then it would be 5 divided by 2, 5 divided by 3, and 5 divided by 4. That's why the concept says that if you calculate the cost on the basis of per unit for fixed cost, it would start changing itself. This becomes 2.5. The other one would become 1.6. And then it would become, the next one would become 5 divided by 4. It is 1.25. So if you see, as the number of units, number of units are increasing, changing. That's what the concept says. But then if you want to calculate the fixed cost, in totality, it would still be the same. So in totality, it is same. On the basis of per unit, it changes. On the other hand, if you want to calculate the variable cost as well, it would start changing in totality, whereas it would remain constant when you calculate it on a per unit basis. So in this example, what we did was we assumed that there is a 2 per unit cost, right? But in the examination questions, this won't be given to you. You would be only given the total variable cost in the question, and you would be told to calculate these costs. This won't be given to you. The cost per unit won't be given to you in the question. So you would be only given a table which has units, variable cost, and fixed cost, probably the total cost as well. And then the table will the question will ask you what is the variable cost of this table. So for calculating a variable cost, what we will have to do is you can consider any of the parameters. So if you want to so you can consider basically any of the units. But you need to understand what kind of formula you're using. So it would be variable cost per unit is equal to, it would be total divided by the units at that level. So if I want to calculate for this for 2 units, it would be total variable cost, which is $4, and the units which I'm producing is 2. So my answer would be $2 per unit. Okay. If I want to calculate it for like another level, so let's say I calculate for level 4 now, number of units, where the number of units is 4. So what is the total variable cost? The total variable cost is $8. And when you divide it by number of units at that level, the answer would again be $2 per unit. And that's why it says that the variable cost per unit would remain it would change. But the fixed cost in totality would remain constant, whereas it changes per unit. That is something which you need to understand. And that's what the slide says. It says the per unit variable cost remains unchanged as production increases or decreases. So remember the word per unit. So we are making 2 comparisons. So one is per unit, another one is total. The total variable cost. So this was per unit. Another one is total variable cost, increases as the production increases and decreases as the production decreases. Fixed costs do not change within the relevant range of the production, as long as the production volume remains within the relevant range. So relevant range would be, in our example, would be the factory area was kind of a relevant range for us. The total amount does not change, but cost per unit decreases as the production increases. So that's what we did here, right? So as the production was increasing, as this was increasing, as the number of units were increasing, we have a decrease in the fixed cost. So that cost is getting allocated into more units now. So what is kind of a mixed cost? So mixed cost is called as semi-variable or semi-fixed. So as I told you that it would be constant for a certain level, and then it would increase or probably decrease depending upon the situation which we have. Semi-variable cost is a small amount plus, so it's small fixed cost and a variable cost, or it could be a small variable cost and plus the fixed cost. So semi-variable cost is small fixed amount plus a variable amount, or semi-fixed cost is fixed for a given period and jumps to the next highest level where it is fixed for a while and then jumps again. So it basically what it is doing is creating a jump, a jump, a jump every time. So it is basically creating a step kind of a pattern. There's a formula to calculate it as well, but we'll check out one of the examples. So what do we mean by total cost now? So a total cost is a cost which is defined by function y which says fixed cost and variable cost. This would be a dollar amount, a total dollar amount, and this would be units. Then it will give you a dollar. Is basically the variable cost per unit, and the x is basically the number of units. So you multiply these two. So for example, the variable cost in our example was $2. The total number of units were $4. Sorry, 4. So this becomes $8 in totality. So it would be $8 right here. The fixed cost in our example was $5 in totality. So this becomes 5 and 8 becomes 30. That's the same thing which we calculated here, right here, 30. Okay, so any questions you guys have on this total cost, variable cost, mixed cost, or the changes which you're going to make? Okay, fine. Then moving on, there is something called as cost measurement systems. So what we had till now, what we discussed was what is the behavior of the cost. Now what we are going to do is we are going to measure this cost based on the different systems which we have. There's something called as standard costing, normal costing, and actual costing. So this is called the way you measure the cost for your budgeting standards. So what is called as standard costing now? So standard costing is a system wherein the planned cost would be attached to the units of production. So the planned cost, that is something which you have already planned in your budget. Standard cost would always be the cost which you require for one unit. So this is very important right here. This is one unit of output. So the standard cost of production of one unit. So whenever you say standard cost, it's the cost of producing one unit. Standard cost of an input, that is one unit, and the standard amount of the output that should be used to produce one unit. So again, one unit every time. So whenever somebody says or somebody will tell you that, or even in the question, if it suggests you that this is the standard cost, it would always be per unit. Or if it is not given in per unit, it is your responsibility to convert it into per unit. So let's say that when we are making a budget, when we are preparing a budget, we decided that based on our past experiences, that when you are going to manufacture something, let's say when you're manufacturing a car, there are multiple raw materials which you require. So for example, you require the tires, you require the fabric, you require the glass, and you require some kind of a residual stuff. So when you're going to make a budget, you always have decided a cost. That is, I'm not going to pay more than, say, for example, $50,000 for the tires. That's my cost. And what I'm expecting is, in this 50,000 tires, I'm expecting to produce, say, 500 cars. So what it does is it gives me my per unit cost of $500, oh sorry, $50,000 divided by 500. That is 100. So 100, the cost which I have already estimated in my budget would be called as my standard cost per unit, and that is something which I would already have, or I would have already calculated. So it's standard cost of the input and the standard amount of output that should be used to produce one amount of unit. So what is that one amount of output you need, and what is the cost you need for that particular output? So if you want to have one tire to be produced as an output, what is the cost you need is 100 unit per unit. So one tire, you have got 100. If there are 10 tires, it would be multiplied by 10. If there are 50,000 tires, it would be multiplied by 50,000. This would be called as your standard cost. Then what happens is, once you have a standard cost in place, so there is a standard cost which you have calculated at the start of the year, and then there would be an actual cost which you have already paid. So let's say the standard units which you decided were, in our example, let's say 500 units, and the total estimated cost which we had was $50,000. That made my stand. When I compared it with the actual figure, so I did compare that what was my actual cost. Did I end up, what was the cost I end up paying? So I thought that, okay, I ended up paying, say, 60,000. Okay, and I ended up paying 60,000, but the number of units which I produced was only 400. So then what is my actual cost per unit? So that would be 60,000 divided by 400, giving me a
150.
per unit cost of $150. So now this becomes my actual cost per unit. So now comparing the actual cost per unit versus the standard cost per in terms of costing mechanism. So your budget said that you would be paying only $100 per unit, but you ended up paying 150. So there is a variance now. There's a variance of $50. That is the difference between 100 and 150. And the question is that, or is this variance a favorable or an unfavorable or to the company? You decided 100, you ended up paying more. So that's why this would be called as unfavorable variance of 50. And that is the reason you need to understand how this standard costing and actual costing system is going to work. Any questions, guys, as of now? No, all good.
Yes, sir. Yes.
Okay. So why we are studying this is because when we want to understand the costing measuring system, it will tell you which kind of a costing you need to apply. So if you have a question which says that you need to apply a standard costing system, then you need not include the actual rates in any of your calculations. The only rate which you are concerned with is the standard rates, because the question is saying you, I want to follow a standard costing mechanism. So there were like three types right here: standard costing, normal costing, and actual costing. If it is a standard costing, you would use the rate of $100 everywhere. I mean, depending upon each of the material, there would be a standard rate for direct labor, direct overheads, or sales, or other expenses. There would be a rate based in your budget, and that same rate you're going to use in your calculations. But then if it is called as actual costing, you'll have to calculate the actual rate. The actual rate was 150 in our case. So every time when you want to give an answer, you'll have to make sure that you calculate the actual rate, which won't be given you in the question. It won't be given you in the question, trust me. There would be actual figures given to you, and there would be actual units given to you. So you, based on the division of that, you can calculate the actual costing. But then there is something called as normal costing. So what is the difference between standard, normal, and actual? So it's the same thing which we discussed regarding the flexible budget. So the cost would be as per actual. I mean, the number of units would be as per actual, but the cost would be as per standard. So let me just elaborate on this normal costing. We'll discuss this example. Yeah. So what you do is when you're calculating a normal costing, or when you're using a normal costing approach, what you need is the rate as per standard and the units as per actual. Once you have this, you should be able to have a normal costing in place. So let's take this example which we have in this slide. Yeah. So once you have this difference of variance of 50 using either, so it would be standard costing versus normal costing, or it could be actual costing versus C at a given point of time would be compared with any of the two. So let's check out this example. So manufacturer using single cost, the manufacturer using standard costing applies variable overheads. Okay. So before that, what we can do is we can quickly understand what do you mean by the allocation rate. Okay. So let's understand what does it mean by allocation rate? Just give me a moment, guys. Yeah, sorry guys, there was some kind of yeah. So the allocation rate, am I audible to you guys?
Yes, sir.
Yeah. So the allocation rate would be the rate which the company calculates based on a certain factor. So what kind of a factor they use? It could be either labor, labor hours. It could be anything which the company wants to allocate on the basis of which. So what you do is there is a cost in the numerator. It is usually a fixed cost, so a cost which is not directly attributable to any of the products, and that gets divided by either number of hours, either number of units, any kind of a measure which the company deems to be fit. So it could be hours, it could be units, it could be liters, depending upon what kind of a methodology the company is using. So that is, so once you calculate this is called as an absorption rate. So now there's like a fourth concept coming in. So there is standard costing, actual costing, normal costing. So these are like the three measurements, and in that the rate which you're using is called a standard rate, actual rate, normal rate, and the absorption rate. Three measures of costing has four rates. So let me just quickly draft you this. So it would be standard costing, then it would be normal costing. Standard costing would have standard rate, normal cost would have normal rate, and this would have the absorption rate. So I am not exactly sure why is it happening. Okay, let me just Okay. So I guess there is some kind of an issue with the iPad. So let me just quickly go on to an Excel itself. Yeah. So the standard cost has standard rate, actual cost has actual rate, normal cost has normal rate, and there is an absorption rate as well. So what we can do is we can have an example on how this costing system is going to work. So let's say if you want to write this example, you can just quickly write this for your reference, because I'm not sure if it is available in the notes which you have. So it's an example about standard costing versus the actual or the normal costing versus the actual costing. So let's say the planned level of production. So this is kind of a given information to you. The planned production is say 20,000 units or dog houses. An actual number of dog houses which was produced or which was developed was 21,000 units. 21,000 dog houses were made actually. The overhead basis, the absorption basis which the company is using is direct labor hours. So whatever absorption is being done of the cost is being done on the basis of the direct labor hours. And to prepare or to make one dog house, so what is the standard? The standard which the company is giving is for one dog house, you need 2 hours of direct labor. This is kind of an information which is given to us in the question. Oh, excuse me. Okay. And then if you want to calculate a kind of a standard for it, okay, then there is some more information as well given in the question. So let me just illustrate that right here. So it is direct material which is required for 1 unit, which is 1 unit in case of one dog house. So how much direct material you require is 5 units. Direct labor you require is 2 direct labor hours, that is already given to us right here. So it is 2 direct labor hours. And variable overheads, it's again based on the direct labor hours, which is 2 direct labor hours. And the fixed overheads are also based on direct labor hours. So what it says is there is one dog house which you need to make, which requires 5 units of direct material, and all the allocation. So this is for absorption. The variable and the fixed cost is for absorption, and the direct material and direct labor standard is given to you in the question. There is also a rate which is given to you for every dollar amount. So for 5 units, per unit rate is $9. Direct labor hour rate is 15. Variable overhead cost rate is 5, and the fixed cost rate which is given to you in the question is 0.5. So based on this information which is given to you, you need to calculate the different costing based on normal, standard, and actual. So this would be 5 multiplied by 9, that is 45, 30, 10, and 13. That's just kind of a multiplication which you're making. So what this does is it is a calculation of cost for 1 unit of your output. Sorry, 1 unit of your output. And now there is also another thing which is given to you in the question, in the illustration, is the total number of hours which are required to you. So I just missed one information, as it would be actual hours as well. So actual hours which were required to you was 44,100 hours. This was given to you for 1 unit, and the actual number of units which were produced were 21,000 units. So this would be 21,000 units now. So what we need to do is, first of all, we need to calculate the actual rate. So how do you calculate the actual rate? This is the standard rate which is given to you. And based on the actual figures, that is actual usage, you need to calculate the actual rate. So let me just brief you on this. Okay. So to calculate actual rates, you should also have the actual cost which was incurred during that period for 21,000 units. So for direct material, the amount of cost which the company incurred was 882,000. For direct labor, it was 617,400. For variable overheads, it was 224,910. 264,600. So this was the actual cost for each and every item which we considered in our direct costing system. And now what we want is the per unit price. Per unit we want. So what we want is either units or the hours. So unit or the hours, the actual ones. So actual number of units were 44,1. Actual dog houses, that is the direct material which was produced in units. So if you see, there is a standard measurement which is being applied. So for direct material, it would be the number of dog houses, which is number of units, which is 21,000. For direct labor, variable overheads, and fixed overheads, it would be the number of hours. We have actual hours with us, so it would be 44,100 for all the 3 parameters, because the company has already decided what is the parameter they are using. For direct labor, it is evident that labor works on the basis of the direct labor hours. But for variable and fixed overhead portion, this could even be the units, or it could be anything which is relevant to the company. So it is not always the direct labor hours, but it depends on what kind of an information is given to you in the question. So to calculate per unit, so this would be the per unit cost which we have. So we have got our actual cost, so the standard cost, we have our actual cost as well mentioned. Then there was something called as standard cost for actual output. So this basically becomes your measure of a difference between normal costing and actual costing. So 1 unit of finished product, that is the doghouse, required 2 direct labor hours. How do I get it? It is given to me right here as per the standard. So what if my actual units were produced were 21,000 units of finished product, that is the dog houses. So if there are 21,000 units of dog houses which were produced, how many direct labor hours would be required to me? So you just have to make a cross multiplication. We'll find an answer. So it would be 21,000 multiplied by 2. That gives me an answer called 42,000 direct labor hours. This would be 2 direct labor hours. Now if you look at these two figures, so this was based on what the standard you had, and this was based on the actual things which you have, the actual output. But this is based on your estimates. If your estimates were correct, you should have been using 42,000 direct labor hours. But what has happened indirectly is you ended up using 44,100 direct labor hours. That is something which is going to create a difference for you. Same thing, you can calculate it for the material as well. So if you see this, so we calculate it for direct labor hours. So this is basically the same. Even if this information is even not written here, it is basically not making sense. So it's just confusing us. So if this is not given as well, you can just take it from here. Same thing, you can calculate it for direct material as well. So so 1 unit of finished product requires 5 units of materials, 5 units of material, that is the raw material. What if I make 21,000 units? What is the amount of raw material I should be requiring? So again, this would be 5. So it would be 105,000 units. So now what you do is you compare that with your actual units which you have produced. And now once you have these two figures in place, it becomes very easy for you to differentiate between the normal costing and the actual costing. So I'll give you kind of a quick table which will help you to understand this in more kind of a detail. So what we can do is we can put a calculation right here on the left hand side. Okay. So calculation based on standard costing. based on normal costing and based on actual costing. Then there would be a rate for direct material this would be direct material, direct labor, then there would be variable overheads, then there would be fixed overheads. So for direct material, we need two things. We need the rate and we need the base. So the rate for the standard costing, the rate which we already had in our question was 5. Sorry, the rate was 9 per unit. This was a dollar amount right here. So the rate was 9 per unit. And because this is the standard costing, the base is 105,000 because we calculated it based on the standard right here. So we were supposed to use 105,000 of raw material. We ended up using 21,000 units. So that will give you an answer of this multiplied by this, which is 9,45,000. So this base, the multiplication base, would always come from standard cost for actual output. What if we use the same unit measurement? What would have been our output? What should have been our output? Same goes for your direct labor. The standard rate, which was like there, was 15. So it would be 15. That would be the rate. The base, we have calculated it based on standard cost for actual output, is this 42,000. So again, if you're calculating a standard costing, you will have to calculate it based on standard cost for actual output. So this gives you your values for standard cost. And what happens for a normal costing is you need a direct material rate and a direct labor rate. So the rate would be as per the actuals. So rate would be as per the actuals. So 42 and 14. So rate is as per the actuals. But the base, that is the multiplier, basically changes. So the rate is as per actual, which was 42 and 14. So we calculated this right here. But the base would now be actual. So it's actual versus actual. Oh, sorry, it should be actual versus the standard, not the actual. It would be the rates. So this one. Yeah. And then there would be actual, which would be the one which you already have the figures for. So it would be the figures which you already have. So this 8,82,000 and 617,400 would be actual into actual. So actual rate was 42.14 and the actual number of units were produced, which was 21 and 44,100. So it would be 21,000, 44,100. So that is basically your standard comparison with every unit. Then same goes for direct labor, because we have already included direct labor here, so we don't want like a specific column for it. What happens for variable overheads is the rate would be as per standard. So rate usually doesn't change. So this would be 5. So where do we get it from? We have a rate of 5 and 6.5. So it will be 5 for this, 6.5 for the fixed overheads. And then the base for the standard costing would come from the calculations which we have, because the variable overhead has a measure which is direct labor hours. So what we need is the standard cost for actual output, which is 42,000. So this would be multiplied by 42,000, the base. This would be the rate. This would be the base. So again, if you see, because it is based on the direct labor hours, you can just put it right down. So there is nothing based on the materials. So this would be 5 multiplied by 42. Same goes for fixed, because it is based on the direct labor hours. It would be again 42,000. And how do you calculate the direct labor hours? Is basically the standard cost for actual output. Standard cost would be standard hours here. This would be the same. And what happens in case of a normal costing is that, let's calculate the actual costing first. That makes our life a bit more easy. So 5.10 multiply and 6, that's the actual thing we have. So we can just copy this from here. So it would be 5.10 multiplied by the actual, which was 4,100. And then this was 6 multiplied by 44,100. That is going to give you an answer right here. Same goes for here. The only thing which is left is normal costing now. So the rate would be the same, but then the hours would be as per standard. So that is kind of a difference between the normal costing, absorption costing, and actual costing. So in actual costing, we had the actual rates and actual output. In the standard costing, we had the standard rates and standard output, standard inputs for actual output. And in the normal costing, we just made a cross multiplication of it, wherein we calculate the rates as per actual and the output as per standard. So rate came from actual. So you see this, the rates came from actual, but the base came from standard. This is all standard. This is all actual. Normal costing is kind of a difference between those two. Same goes for variable overheads. Because the base was labor hours for both, we did 42,000 considering the labor hours. If the base was given to be as number of units, we would have calculated the number of units and put it into 42,000. So that is something which is kind of a part of your exam. So the usually what happens is they always tell you to calculate the actual costing, and then based on this they tell you to calculate the actual figures. The most important part is this calculation which we made here, this standard cost for actual out. This is something which would always be there in the exam, and they'll tell you what would have been the standard cost if the actual output was this. So the question would be, what would have been the standard cost if the actual output was 21,000 units? What would have been the standard material cost if the actual output was 21,000 units? That would be one of your prime MCQ questions coming in. The next could be, what would have been the, what is the standard material cost if the standard output is 21,000 or the 20,000 units. So there is a difference between these two things. What would have been the standard material cost if the actual output was 21,000 units? So if the actual output was 21,000 units, and based on the standards, the material which you need to use is 105 units. So this is standard for actual, and then this one is standard for standard. This would be there every time given to you in the question. This would be given because if it is not given, the question doesn't fit in. So this would be given to you in the question. The one what I'm talking about is this 5, and these actual units would also be given to you in the question. This would be given, and actual units would also be given to you, which is this would also be given. So based on these two kind of parameters, you can always find the costs. So this is something which is kind of a prime MCQ. So just keep a note of that. So guys, let's take a quick 5 minutes break, and we'll come back within like 5 minutes of the time. Okay, guys, we will start with the with the further topic. So the next topic is basically analyzing the variances and how to interpret those variances. So for interpretation of the variances, there are a few calculations which you need to understand that we did discuss a while ago. So please remember one thing that even if you're not comfortable doing this normal costing, it is important that you are aware of this standard cost for actual output concept, because that would be the base of all your variances coming in future. So usually when you prepare a budget and there is a variance at the end between, I mean, there's a difference between your actual figures versus your standard figures, the management is going to tell you to drill down those variances. And what is going to happen is the variances are basically calculated at three levels. So variances, when they are calculated, they need to be calculated at a specific kind of a kind of an area or kind of a level. So the variances overall are divided into three levels. So there is level 1 variance, then there is called as level 2 variances, and then something called as level 3 variances. So when you talk about level 1 variance, this is called as static budget variance. This is called a static budget. At level 2, you have got two variances. One is called as flexible budget variance, and the other one is called sales volume variance. At level 3, you basically have manufacturing variances, and under manufacturing variances there are material variance, labor variance, and overhead variance. So this is kind of a three level uh, variances which are there in your course, which you should be familiar with. So let me just type in the formula first before that I get into an actual concept of it. So a static budget variance is basically the difference between the actual budget minus the static budget. So static means your master budget which cannot be changed, and actual is the figures which you write against the actual the standard figures. The flexible budget variance is basically the actual minus the flexible budget which you will have to prepare. So this is something which is not there, which this information is not available readily in the question. This is something which you will have to calculate. So actual figures would be there, standard figures would be there, but for flexible you will have to calculate. Sales volume variance is a difference between flexible minus static. So again, if there is a flexible thing, we'll have to calculate it. How do you calculate it? It's the same thing which we did just discuss right here. So the rate is as per the standard, the units are as per the actual, and then there are variances between for materials, labors, and overheads. So material in all have 5 variances. Labor also has kind of a multiple variances. So I guess there are 5. And then there are overhead variances, which are approximately 4 variances to deal with. Once this is done, there is also called as level 4 analysis of variances, which is called as 4-way analysis, 4-way analysis, 3-way analysis, or a 2-way analysis. So these are the kind of a roadmap or the index of variance. So if you see, there are multiple stages of a variance, but there is a simple trick to remember all the formulas. So you don't have to keep on what to say is keep on learning all the formulas. There is something called as a basic formula, and from that basic formula you can always generate the remaining of the formulas. So I'll help you with that. So before that, let's understand what kind of a variance we're talking about level 1 and level 2. So for that, there is an illustration given to you. So this is kind of a statement at the start of the year which the company makes. So there would be a statement which would have its static budget, which the company would be making, and then there would be the actual results as well. So based on the actual results and the static results, you'll have to calculate your flexible budget first. So this was something which we discussed in the last class as well. So the static budget the company prepares at the start of the year, start of the month. Actual results is your final results of what you did. And there is something which you need to calculate is called as flexible budget. So how do you calculate the flexible budget? So units would be kind of an irrelevant for this. That's why it is given as 0. That is only for calculation purpose. But then how do you calculate the flexible budget now? So your static budget said that 288,000, that is like 4 times 0, divided by 24,000, that becomes 120. So this division would become 120. That is your cost, standard cost. And what is the actual units which you produced? Was 20,000. So you multiply it by 20,000, and that gives you 24. This was the same example we did in the previous class. So using the similar standard cost, so there is a difference between standard cost and standard cost for actual output. So when you say standard cost, it is just the layman's division. But when you say standard cost for actual output, you will have to use the standard cost multiplied by the actual output. So this flexible budget is nothing but your standard cost multiplied by your actual output, which is also called somehow as normal cost. Static budget is your standard cost multiplied by the standard output, and your actual cost multiplied by your actual output would give you your actual results. So this is the difference which for every example you will have to calculate. Even if there is a variance question, just make sure you have this figure available with you. If you don't have this figure, you're going to mess it up. How do you calculate this figure? You need to calculate the standard cost. How do you calculate the standard cost? You divide this. So for example, if I want to calculate the standard revenue, like the standard price for the revenue, I'll have to divide this 2,880,000 divided by 24. That basically gives me 120. And then I put 120 in place of standard cost. I multiplied with the actual output, which was 20,000, and I get my flexible budget. Same can be called as the standard cost for actual output as well. So the terminology is a bit confusing, but if you just concentrate a bit more, you should be able to figure that out. So once you have the flexible budget in place, so you had your static budget, you have your static budget, all the figures for each and every P&L item. You have your actual budget as well based on your actual figures, which have been actually incurred, and then you calculated your flexible budget as well. So once you calculate all these three, now we can come to our formula which we are discussing. So if you want to calculate a static budget variance, what you need is the actual figure minus the static figure. So for example, if I want to consider a material item for an analysis, so it would be the actual minus static. So the actual is this and the static is this. So the difference between those two would be my variance, and that variance would be called as static budget variance. So that's what this arrow says. So you take it actual right here, and that's the standard. So that's what we did. If you want to calculate a flexible budget variance, we need actual minus flexible. So if we want to calculate a flexible budget variance, we need the actual figures and we need the flexible figures. The difference between the two will give you the flexible budget variance. If you want to calculate the total sales variance, it would be flexible minus static. So it would be flexible, this one, and then the static budget variance. So in this example, what they have done is that they have basically calculated the variance at only one point, which is at a profit point, which is at the bottom. If you see, there is an operating income variance which they have calculated ultimately. If you calculate it for every level, your answer would again be this one. So why it is negative right here? So it says, so if you want to interpret this, it would be, so when there is a flexible budget or a flexible word coming in, you can always treat it as a standard for interpretation purpose. So as per my standard, I was supposed to make a profit of 88,000, but I ended up making 29,800. So that's why my profit was less than what I expected, and that's why it is an unfavorable variance. Don't just be dependent on the plus or the minus signs. It's the way you put the formulas in. Okay, so I budgeted 88,000 as profit. I ended up 29,800. You ended up at a loss. Basically, you were like way below your estimation. But then if I want to calculate the total sales variance, what is going to happen is I estimated 216,000 as my operating profit, but then I ended up having 88,000 when you compare it with the flexible budget. So this one would now become the actual comparison for this formula. So I requested for a profit of 216. I ended up having 88. Again, it's unfavorable for me. And how the total is going to work is I budgeted 216. ultimately I ended up having 29,800. So the overall loss or the overall less or overall unfavorable situation for me was 186,200. So this is kind of a 3-level variance which we have. So level 1, level 2, and level 3. So once you calculate these variances, so this is kind of a primary variance analysis. Whenever you do, or whenever you are into kind of a practical role, even in your offices or in your professional life, you don't jump into level 3 variances directly. So you have a P&L statement with you. You calculate the you have your original P&L statement, which was kind of an estimate. You would be having your final P&L statement once it is finalized at the month end or the year end, and then based on that you calculate your flexible statement. You calculate your level 1 variances, level 2 variances, and once you have this level, like level 1 and level 2 variances, then you move on to kind of a deep drill into it. So that's what basically the question says, or the illustration says. So once you're done with level 1 and level 2, you need to move to level 3 variances now. So level 3 variances. The first variance in level 3 is material variance. So there was a variance in total of this much, and it was because of materials, it was because of manufacturing overheads or manufacturing labor, variable overheads, and the fixed cost. So my concern is, which is one of the most impacting factor, which is basically giving me a negative profits or kind of a less profits which I'm expecting. So where I'm going wrong, that is something which this variance is going to tell you. So initially what you did was you had your base figures in place based on your final operating income. That is your final result. That is something which we started with. And now what you're going is you're just keep drilling the things down. So there is a standard formula for it. What I usually do is I usually don't remember these formulas because I only have a standard formula with me, which says you always subtract standard minus actual. You always do this, standard minus actual. So standard cost minus actual cost. Standard minus actual. Just remember this kind of a difference. There would be multiple ways to calculate the formulas, but I'll tell you the simplest way to do it. So for material variances, let me just write it somewhere here. Yeah. So for material variances, the first one is called as the price variance. The question is, my profit was low by 186,200. My profit was less by 186,200. That's what the statement says. So the first question which arises is, in the material section, was it because of the pricing difference? Was there a situation wherein I estimated a X amount of price, I ended up paying more? So in my estimated budget, I had a price of say $5, and I ended up paying say probably $8. So why did I end up paying more? That is one question. And was the price the determining factor? So it says it's price variance, that is material price variance, would be standard. The basic formula is standard cost minus actual cost. So just remember this formula. Because it is price, so you replace cost by price, so that becomes standard price minus actual price. And because this is kind of a per unit, this would be per unit, it needs to be multiplied by the quantity to get the overall figure, to get the holistic dollar value. So this would give you the total dollar value. So my actual price, say for example, so the standard price which I had was say $5. So this was per unit, and I ended up paying 8. and what was the quantity which I was affected with. So this would be your actual quantity. So for example, my actual quantity was say 5,000. So that is the difference which I'm going to make. So it's 5 minus 8. So that is a $3 difference on every single quantity. And I had 5,000 quantities which I did manufacture in actual. This gives me a variance of a negative. So this is an unfavorable variance for me because I started with 5, I ended up paying 8. And this is the difference which is going to create. So this would be actual it could be actual quantity consumed, or it could be actual quantity purchased. Okay, it depends. It is usually consumption. 99% of the times it is consumption. But if your question says that you need to calculate the price variance at purchase price or the purchase point, you need to calculate it at the point of purchase. That is, you need to multiply by the amount of quantity you have purchased. If it says you need to calculate it at a point of consumption, which is this is kind of a default, then you need to use actual quantity consumed. So this was kind of a material variance because of price and quantity. So the second one is quantity. This is called as price variance, and there is quantity variance. So what happened? I did a loss. Was it because of the quantity usage? So the quantity variance would be equal to, so instead of standard cost, because it's a quantity, I'll use standard quantity. This is actual cost. Because I'm using a quantity, so I'll use actual quantity. Again multiplied by, because you have already multiplied, you have a difference of quantity. So this would be in total. What you want is the standard price. So just remember one thing. Once the price variance is calculated, so it's once the price variance is calculated, all the other variances are multiplied by standard price. Then you don't have to consider that which multiplication you have to make, because you have calculated the price variance separately. All the variances would be multiplied by the standard price. So when you say standard quantity, this is standard quantity for actual output. This one, you're not taking 21,000, you're taking what is for the actual, the flexible. Then there is another variance which is called as the mix variance. Which says, was there a difference due to the mixture of the quantities? So the proportion which I was supposed to use and the proportion which I used in actual, was there a difference between the proportion? The quantity was the same, but was there a change in the proportion? That is something which is going to tell you that this variance is going to tell you that. So it is RSQ, that is revised standard quantity, minus your actual quantity. It's again the same thing. It's standard minus actual. It's standard minus actual. Standard minus actual. Standard minus actual. And then, because we have decided that once the other variances, once the price variance is calculated, all the other should be multiplied by standard price. I'll brief you on this a bit more. Then there is something called as yield variance, which means that was my yield, the yield which I was supposed to get from my raw material as per the standard procedures, was less or more. That is something which this variance is going to tell you. And because this variance is kind of a cancellation of this, what I usually do is I usually put this figure right here. So I've just remembered it this way. So you put RSQ right here. And because we have decided that there would be standard months actual, this becomes your actual. And then there is standard quantity, which you already have. That's how it becomes. That's how you remember the formula. And then, as we decided, once the price variance is separated, all the things would be multiplied by standard price. If you want to, so there is a bracket right here. So just to tell you, there is a bracket right here, which I was not able to make it right here. That's why there. Yeah, that's kind of a bracket we have. Once the price variance is separated, everything is multiplied by the standard price. Same thing would occur when we are doing price variances. Oh, sorry, the labor variances. So if I want to calculate the labor variances, what I'm going to do is there's nothing called as consumption and purchase. So this the second point won't be there in the labor. But instead of standard price, it would be standard rate. Instead of actual price, it would be actual rate. The rest remains the same. So instead of standard quantity, it would be standard hours or standard labor hours and actual labor hours. What is the mix? It's revised standard quantity. It would be revised standard labor hours. Actual quantity would change to actual hours. This would be standard hours, and then this would be revised standard hours. The formula remains the same. This would become labor. Okay. So if I want to quickly give you a diagram on this, so it would be material variances. There's one variance still left, which I'll tell you can be divided into two parts. The first one is price variance. The other one is quantity variance. The quantity variance is again divided into two parts, which is mix variance and yield variance. And how do you calculate the total variance of material? You can just add up these things. So you can add the mix variance versus and the yield variance, you'll get the quantity variance. You add it with the price variance, you'll get up the material variances. All good? Any questions, guys, you have?
No, no, sir.
No questions? Okay. So guys, there is quick kind of, because I was getting a few questions on this pre-CMA and FMAA part. So in this pre-CMA class, there are a few FMAA students as well. So what happens is once you're done with your FMAA preparation, you can also pitch in for a CMA if you want kind of a greater qualification or greater recognition. So if you study for a month more after your pre-CMA, little bit more for like probably a month or something, then you should be able to give your FMAA exam. So basically what happens is you have got two options. So you can convert, you can extend your pre-CMA class. That would give you like an FMAA later on. Or you can directly go to CMA US after 1 month of having a pre-CMA. So once you're complete with this pre-CMA aspect, you can directly jump onto CMA classes if you want to. So these are the two extensions which are basically available right here. So you do a pre-CMA class, you can enroll for, you can just study for 1 more month, like complete your MCQ questions in much more detail and have the things in place and revise a bit more, and you can attempt your FMAA exam. So that is something, that is one option you have. The other option is once you're done with your pre-CMA, you can always directly enroll for part 1, part 2 of the CMA. So these are the like two options you have as of now, because I was getting multiple questions on this. Even the coordinator was having a bit more questions which she had. And then there would be one test as well, which would be arranged by Uplift professionals for once this pre-CMA session is over. So in pre-CMA, it is more to do with your conceptual clarity and kind of a basic understanding of the concepts if you have. So I know that, so it won't be more kind of a practical thing, it would be more into conceptual things. So if you still have any conceptual things which you need me to explain you, I'm happy to stay back. Otherwise, I am done for the day. Or anything, guys, you want me to add on, or any other random concepts you want me to tell you about the course as well, about anything else, any random things. Okay, so I'm done for the day. I'll see you in the next class then.